Good morning, everybody. Welcome to Friday. I hope you're well. There you can see on your screen a representation of the pound today. Hope you're all having. Hope you're doing well. We're not getting caned by that. Morning, Kay.
Good morning, Brian. Ryan. Good morning, everybody. Did I just call you Brian?
Yes, you did.
That was our first English lesson when I was a kid. It was like, where is Brian? Brian is in the kitchen.
Well, it's Friday, mate. You can call me
Why,
anything.
why I
It's polite.
recall that it's like anniversary time today. Yeah, 30 years that the Bank of England had to let the pound go, and Soros made a ton of money, and all those short sterling made an absolute cartload. If I recall well, this is the first jumbo profit I recall of banks and speculators making at that age in those days. Yeah, it's been times then.
Funny times. Yeah, some might say there's a few people trying to push other central banks into difficult situations. Probably most notably was the S&P, I would think, in a similar vein, let's say. And look at the carnage that caused there. But anyway, such is life. Yep, 30 years today. And the pound is trying to get its way back down there as well. It's also 20 years of the euro, as ECB's Lagarde has been celebrating. And the euro's trying to head down to those 20-year lows as well. So history repeating itself maybe today.
Where was she 2019? Because the euro got called into life on the 1st of January 1999. And why is she celebrating 20 years of euro today?
Yeah, well, it was obviously the 19 whatever it was when it actually came. Well, actually the banknotes came out, wasn't it? When you could actually get it in your wallet. But back in '99, she was probably trying to avoid jail in those days. But less said on that, I suppose. Right, no Stell today. He must be down the beach as usual, getting his morning paddle in. So we shall get straight into it. Right, where should we go today? Quite a few notes, bits and pieces to get through. Let's start with China. And the PBOC, they say they have ample room for policy, or ample monetary policy room. That insinuates that there's perhaps some further easing to come. That came after the Stats Bureau, the Chinese Stats Bureau, was saying that excuse me, the demand recovery is slower than supply, and that China faces more complex and a grim situation than it did in 2020. So now we know these guys are on the easy path at the moment, not going kitchen sink on easing right now, but they are possibly in the pipeline to step that up. The FT also had a piece out saying that local regions and state, what we call them, banks or whatever they are going on a land buying spree. If there's one thing we know with China, if they want to show positive numbers, they can go heavy on the investment. A lot of that investment is obviously goes into property and building the so-called ghost towns that we see about. That gets productivity up, that gets GDP up, that gets investment up. So potentially they're buying that land, and one of the uses could be for more property, which would tell us that they're going to further support the property market and all its woes there. Now, we also had the Xi Putin meeting yesterday. The comments with that weren't really anything inflammatory. A lot of bit of lip service to each other. Nothing particularly from China that said they're wholly backing Putin. Putin was reportedly said to say that he respects China's balanced view or balanced stance over the situation regarding Ukraine or what they're attempting to do. So there wasn't a explicit backing by China of that. They have been sitting on the fence a little bit over it. But for risk purposes and trading purposes, nothing too shocking from those comments either. Now, overnight, we've had obviously a bit of developments in the yuan, busting the 7 level yesterday. The PBOC, after I think about 16, 17 days, fixed the rate above expectations for once at 6.9305 versus 6.9228 expected. I think I haven't checked, but I think it was 6.91 something yesterday. Well, I think we're back in the situation a couple of weeks ago where these fixed rates are now more chasing or following the moves rather than trying to set any sort of boundaries, the likes of which we saw, beginning of this week, late last week. They've also extended their onshore trading hours today until the 30th of September. I'm not sure why they've done that, whether it's just to provide extended liquidity time against these moves. I'm not sure. What do you make of that, Kay, the extending the onshore hours?
Yeah, I don't know. Maybe they are. I really don't know, but they could be a bit nervous, getting a bit nervous about the speed of the yuan weakening. But I haven't really read anything about that. What I would like to point out, though, regarding those Xi and Putin comments, is that Xi was like trying to walk a bit of a fine line, but then behind the scenes, where are they exactly? Is it Kazakhstan or Uzbekistan where they have these meetings? You have this SCO organization, the Shanghai Cooperation Organization, and there they commented a little more harsh comments against any involvement and tightening the cooperation, talking about training. 2,000 law enforcement headcount in China to help this SCO tightening the leash on everything. So it's not really Xi who did it, but through the back door, they do still continue to tighten measures and trying to get more grip on whatever's happening on their lines, right? Between you draw a line between China and then Russia, the borders, and you end up where all these countries are, and it's like a life-size game of Risk that they are playing there.
Yeah, with us as the pieces. But yeah, they also said, or he said about, will welcome all countries to sign up to China's Global Security Initiative, whatever that may be, and that they will prevent foreign countries from instigating colour revolution. That harks back to some of the revolutions we've seen around the globe. So yeah, as Kay says, a bit more stronger in another setting other than Putin, than with Putin. But of course, what the public comments are from that meeting are one thing. What they actually said to each other in the meeting is another thing altogether. But at least publicly, it doesn't seem like China are making a case or setting their stance either way. And of course, they're just sitting watching what happens here with regards to Taiwan, which is a constantly bubbling situation. So anyway, one thing I want to point out, though, is that we did get better data from China overnight. We got some industrial production and retail sales showing much better numbers there. Also investment categories there also on the up. So despite the softness that we've been seeing in China, and a lot of it has obviously been down to COVID restrictions, there are some signs that the data is picking up a bit. But as I just mentioned, the Stats Bureau see that the demand recovery is slower, so it's not going all guns blazing as yet. So a bit of a mixed picture between maybe the longer term view and what's happening in the data. Sticking with the data, we'll just nick back to yesterday and the flood of US data that came out. Quite a bit. Jobless claims heading back in the right direction. Lower claims there. 4-week average dropping back again. Then we got the first manufacturing data of the new month via the Empire State and Philly Fed. Empire came in better than expected, still a negative, but the real news there was that while employment was largely unchanged in that number, prices paid fell 16 points to 39.6. That's now down 39 points over 3 months. So the prices paid category is reflective of inflation. It's what firms are paying for their goods to be manufactured to then sell on. So there's always two prices categories: prices paid and prices received, i.e. what they receive from their customers. So that was down 16 points, as I say, down 39 points over the last 3 months. The Philly Fed came in negative as well on the headline. There was a steep drop in the employment number there to 12 from 24.1. And again, the prices paid category fell also to 29.8 versus 43.6. So in that respect, the Fed are ticking their boxes. If you go just by these small numbers, they want to crimp demand, and they want to, and they say the consequence of that is bringing employment down, unemployment up, and obviously the inflation numbers there coming down. Now, the Fed aren't going to change or pivot over these two small indicators, but the trend is your friend. And if this is going to continue and we start to see these metrics, employment dropping, inflation dropping in the main numbers, then that's when we start to question where the Fed are going to stop hiking. So for the moment, you know, in these small data points, we're seeing exactly what the Fed want, but it's yet to be confirmed in the main numbers like the NFP and indeed to a larger extent in CPI, PCE, that sort of thing. Retail sales were out as well, a bit of a meh number. On the whole, I'd say they're a little bit soft. Core sales were came in flat versus 0.5 expected. They're all the way, oh, where are they? They're not on here. Where are they? Don't know where they are. They're not on there anyway. But retail sales 0.3, the headline number there, you know, round about expectations. There's been nothing really shocking from the retail numbers of late. You know, they can be quite volatile. You know, if you see them down 1-2%, then you know there's something going on. Obviously, these aren't adjusted, so real retail sales are still likely in the negative, hence why we continue to give it a softer slant. But we're not in any sort of collapse territory where the consumer's dried up altogether due to feeling the pinch from higher rates, etc., etc. So that's it from the US data side. Coming into today, we obviously had one of the big drivers of the pound move today, and that was the UK retail sales. Pretty horrendous looking at them, if you like. Core retail sales, that's excluding things like fuel and etc., down 1.6%. Headline retail sales also down 1.6%. The pound has moved into that stage we had a few weeks ago where it was sort of the poster boy for if hikes are going to bite and if inflation is going to bite, the negative consequences are going to be seen in the economy. You know, that was pretty much a lot of the move that we saw in the pound, pretty much from the 120s. Let's just get that up quickly. You know, when we had this move that, oh, where are we going? Let's come out a bit. You know, when we had this second leg down, or this latest leg down, was coming amid, you know, central banks hiking, but everyone thinking the pound is going to come out the worst, or the UK is going to be the worst economically. And this sort of data is now confirming that. So it's a similar situation where the market is going to be testing the Bank of England's resolve to be able to hike into this sort of economic weakness. It's a similar thing to what they keep trying with the Fed and keep getting a slapped arse over. But they've got more ammunition to do that against the Bank of England. That's one of the reasons why the pound is under the cosh again. As Kay mentioned yesterday, there's a political side of it as well. With Truss, you know, getting loosening the purse strings, you know, lowering regulations on this, that, and the other to try and boost the economy, and also the potential simmering bun fight to have with the EU surrounding Brexit. So that's the situation the pound finds itself in. Kay, you got any thoughts on the quid right now? It's turned into the euro. Don't want to buy it if offered it to you cheap.
Yeah, it was strange on the sterling, right? It kept bouncing off relatively important levels, but then today it looks like yeah, when risk off hits, we know that the sterling has been a risk currency and is a risk currency somewhere. But yeah, it's really a combination of everything. I think market not very confident in Bailey either, succeeding to tackle the monetary issues that there are, and then with trust, and then data now starting to weaken. It's a combination, and of course the other side of the pair, dollar strength, euro seemingly, ECB seemingly wanting to play the catch up now versus the FOMC and being the bigger block. It took euro sterling up, and then we have those warnings from the MOF in Japan, probably weighing on sterling yen, and everything came together against the sterling at once over the past couple of sessions, right? From the 117 kind of zone, we bounced up to when the dollar was correcting, and then from then on, it's been one-way ticket lower. So yeah, everything is a bit against the pound right now.
Yeah, and I think there's also a bit of commodity weakness influence. You know, the quid, when it wants to be, can be a bit of a commodity currency as well. And we are seeing weakness in the commod space, which is affecting commod currencies. You only got to look at Aussie CAD, Kiwi, you know, all the rest of them. And it's just for the pound, it's just, you know, how many different reasons can you mount up in the bag as to why it should be negative. But yeah, that's definitely there. And on the ECB, the traders are actually pricing in 200 basis points of hikes. So the rate to be at 2.75% by June. So, you know, depending on how they want to do that, 200 pips isn't a lot to gain over the next, what's that, 10 months, 9-10 months. So not really a steep path that traders are expecting there, considering that the Fed might be, you know, close to that or over that by the end of the year. So there's still some catching up as far as that goes. And speaking of Japan, their top FX guy at the MOF Kanda, he's speaking at 11 o'clock GMT, so in just over 2 hours time.
1 hour.
No, just over an hour's time, 12 o'clock UK time. Speaking on the economy, we have had the usual waft of comments out from Suzuki, I think, overnight. Nothing of note or change there to the usual stuff. Watching FX, one-sided moves, excess volatility, blah, blah, blah. But this is an actual appearance where he's speaking, so keep an eye on that one in case he decides to drop some bombs in there. That's all I have on the headline and bits and pieces front. Just later on today, we do have the Michigan Consumer Sentiment Survey. Let's get that up for you. Oh, no, where am I today? This is the flash reading or preliminary reading. Keep an eye on those inflation expectations. Those are going to be the ones that the market is going to pay most attention to, as well as the headline sentiment number. But it's all about the inflation. If we see these starting to roll back now, that's another tick box for the Fed on achieving their goals with their hiking. If it collapses, then that's going to get the market thinking that the Fed may not have to go as high on rates as they are thinking now. And actually, those rate expectations are creeping up where the market thinks the terminal rate is going to be. We've had a few stories this week where some traders are using the various instruments, SOFR for one, to play option strategies, predicting that the Fed might be at 5% terminal rates or 4.5% in this case by next year, the end of next year, and some other traders are playing for 5% terminal rate. So we're seeing the rate expectations in the market creeping up above where the Fed dots were at the last projections. So the dots are going to be a big watch next week at the FOMC, just to give an early heads up on that, because the Fed, I think the top end was around 4.25%. I'll have to double check where the Fed members saw the terminal rate before it started coming back down. The market is now starting to get up above that dot plot level for where they see rates topping out. So that'll either get confirmed or denied by the dots next week. That's going to be very important for the FOMC. Kay, you got any other headlines or anything of note this fine day?
There's just one thing that I've seen. It's of course a comments and analysis piece. It's not. It is not a how shall I say, hard data piece. But some BOJ.
What's that? I missed the beginning of that.
Okay, so I mean, the only thing I've seen is a piece about the Bank of Japan next week. Analysts in Japan, Bank of Japan watchers, are saying that something could go missing from the next in the next statement, and that's the word temporary in regards to inflation. So they do think that the Bank of Japan might start to change their wording, which would be in line with what other people are saying. And well, I've put question marks around that as well. Are we going to see some change in the Bank of Japan's approach now that other central banks are really ramping the rates higher, and the yen is weakening a lot because of that? So I'd say that's also an early heads up, because we will have Bank of Japan on the 22nd, if I'm not mistaken. Yeah, on the 22nd. So that's an early heads up for people trading, watching the yen. We could be in for a little bit of a change in terminology, at least for the time being. Kuroda is still buying JGBs. He still has said that for the time being they won't be changing the yield curve control. But it's always interesting to keep in mind that we have those changing environments of expectations. Like Ryan was just talking about the rate expectations for the Fed. Well, the rate expectations or the communication expectations for the Bank of Japan seem to now start to shift just that little bit in the market as well. So that's worth keeping in mind.
Yeah, good stuff, mate. Good stuff. Dollar yen's actually been fairly quiet. It's almost kicking back with its feet up compared to what's going on elsewhere. Which again has led me to think that you know, I was looking around some of the market today. You know, when you're seeing dollar yen doing nothing, you know, and dollar yield, US yields also doing nothing compared to, you know, just on the day per se, as opposed to anything else. But you're getting moves in other pairs and other currencies. You have to start looking around, or I do anyway, just to find out what wind's blowing which way. And I think a lot of the influence today is the commodities. You know, we've got copper down here. Well, copper, that's the Hang Seng. Let me get to the right part. Where are we going? Where's it gone? There we go. You know, we've got that on the slide. We've got nat gas on the slide. We've got gold on the slide. I really should put all these together in the same place, shouldn't I? Gold on the slide, as we saw yesterday, the break below the big 1680, 75 area. Silver's on the slide as well. You know, and we're seeing that pretty much reflected, as I mentioned, in the commodity currencies. So, you know, it's almost as if dollar yen's taking the day off for now, letting everyone else have a go. Price wise, we're pretty much still bang in the middle of the confirmed ranges, double tops, double bottoms. That sets our wider targets. You know, what you want to do in the middle here is up to you. You know, level around this 142, 80, 85 area. A bit of an on-off level over the past couple of days. Also, this 143.50 area, you know, not really being able to hold above it. So it's keeping indecision in this pair for now. A bit of settlement, as we've been saying for the past will be 2 weeks now. Been expecting maybe some consolidation to happen in this pair after the last leg up through 140 and hitting those 145 highs. This is pretty much indicative of seeing that consolidation. So if we're going to go anywhere, we either need to break through that 141.50 or break above that 145 area, you know, and then we're off and running to pastures new, should we say. Until then, we're a little bit in the middle. Trade it as you find it, as they say. Looking a bit more at the pound, euro sterling. Yep, we've got the break finally of the 87 level. I got stopped on the balance of my shorts, 87.30, while I woke up. I'm obviously thankful that I took some off the short down to the 50s. Didn't quite get as low as down there, but it meant I didn't actually lose as much, or I gave back a little bit on top of what I made, so no real damage done there. I haven't gone with the break. I'm in an R-in this morning about whether to nip into a long while it was looking like it was holding, but that data risk was there. I didn't touch it, and it's gone flying. So for now, the sentiment, as we know, in the pound is looking a bit crappy. We've got every chance now of moving up. Let's zoom that out. Moving up towards the 88 handle and the 61.8 fib of the big move down from the 90s. That's going to be the next area to look for. If you're looking to get in this one, I'll be looking at support back into that broken fib area and the 87 handle. If we come down there and confirm it, I'm going to be looking at myself perhaps for trying to get into a long if we haven't missed it. Going to be careful of what the driver is of getting us down there. If it's sudden bad news for the Eurozone, then that potentially means we're going back in the box. So I'm still not keen on trading this for mainly from the fundamental side. Although the UK seemingly heading south again on the economic data is going to be a boom for this to continue higher, especially if the Bank of England do perhaps ease off the hawkish rhetoric next week because of the data coming up. So every chance this could carry on going up. So keep an eye on the levels there. If we get back up into over this fib, then we're heading up towards the 90s, and we'll see what we do up there. Kay, do you want to have a little flick around a couple of your charts?
Yes, sure. I'm going to try to keep it short, but yes, for sure. Shall I? Yeah. And the first chart I'm going to show is has been asked to us yesterday, and to have a look at it, and pointing out the 165 in sterling yen, and that's Gavin. So Gavin, congratulations for spotting that level, because we yesterday were on it when we were talking on the Flow Show, and we had a look at it, and you absolutely spotted that 100%, and it was the top of the move, and we are just only 200 points lower. You could have done better, but all right. I mean, 200 points. No, it was an absolutely fantastic call, and we are on a bit approaching a bit of a support line here, in my opinion, which is around, call it 162.5, and there's a bit of going on at 162.40 as well. So absolutely great call. Another reason why people should make some publicity about this show, because it's not only us doing the work, but people who joining in and who comment absolutely perfectly on what may and what could happen. It's a real addition to the show as well. So well done, Gavin, for spotting that one. I'm going to have a look at gold and silver today. So So we had this break, as Ryan already said. I have a bit of a trend line coming in here, which has been traded with several touches. We had a bit of a false breakdown here and then a bounce. I think this 16, call it 55-ish, is going to be interesting. We are just a few bucks above. People are looking at 16, 17. I must admit that I have must be, where does that come from, that 16, 17? But okay, a lot of people are looking at 16, 17 could be a bit of a target of this move. It is possible. Otherwise, the major next flip awaits at 1560s only. But I'd say it's Friday. We can have an overshoot. To decide upon whether we are really going for the big one, I think we need to wait next week. As well, I want to quickly remind people that it's OPEX day today. Things can get really wonky into the New York close, into the New York afternoon. From London fixing time onwards, it could get really funny, and moves could be really erratic and unexplained for fundamental reasons. So be careful with your positioning later today, I'd say. So that for gold. Silver as well, broken below the trend line here. I'm carefully watching this one. Okay, I'm long term. I'm not changing anything. I'm keeping my long term position, but that's hopefully out of reach for any movement for as long as silver doesn't go below 12 or 10 bucks. But the one closer to home, I think this 1870, 1875 zone is relatively interesting on silver as well. It's been a prior bottom. It's been a bit of a traffic zone in the past as well, here as well. So keep an eye on these 1870s in silver. If gold would do another leg lower, silver may not like it either and go test down there. I'm going to skip the euro dollar. We've been up and down in this zone so much that it's not really worth talking about this. There's some really very short-term intermediate level around here, this 99.30. But really, as we had been talking about it, it's really the 99 zone and 20 points below, 25 points below is going to be important. The one thing I want to just talk about while we're on the euro is that we've seen those risk-off moves happening now in the market, and I think it's one of the reasons why dollar yen is stalling as well, besides MOF concerns, is because a lot of crosses have been bought back in the euro crosses. Have been sold in yen crosses, and particularly in the euro, the last 2 days, we've seen euro crosses really ramp higher. You look at the euro sterling for one example, but you look at everything really. Euro Aussie has been on a rampage. Euro CAD has seen a big move higher, and they're all the same. Euro is a bit of a risk currency in case where it goes risk off. Because when people, for a couple of reasons, where euro is also a big block and can sometimes be seen as a not really a safe haven, but when things are going well and the euro being low interest rate currency, there's a lot of carry trades going on, but when risk starts to hit the markets, then the other side of those pairs are coming into danger, and that's where we see those euro crosses ramp higher. But I have a question mark here: is that now we've seen those crosses go higher, we've at the same time seen supply in above parity in the euro dollar. So I'm a little bit afraid for the euro today, and it's just a feeling or an impression that I have is that today may be one of those days, being Friday, where euro dollar said, okay, I've had enough, we bought enough, euro crosses back, and now euro dollar is leaving the boat as well. I'm not saying it's going to happen, but the fact that we can't hold above parity is ringing some small alarm bells. And then I want to talk about a couple of others quickly. Dollar NOK been on a tear since the 980s. Over the various shows, we've been talking about those dollar NOK levels, and yeah, the thing really took off. We are now, and we've broken above a very small trend line resistance here, and dollar NOK is trading 1% higher. We've talked about the risks hanging around the Norwegian kroner, with gas, with Brent, with Norges Bank selling Norwegian kroner every day, and the dollar being beat across the board. So here we are. It's possible to see this these 1035s come back into play. If ever we are breaking higher, this could be on the cards. Move up in the 1060s. Why not? You know, but we'll have to see how next week develops. I have a pretty bearish feeling towards the NOK for the second half of September. I think those NOK sales could weigh the way that oils are behaving, gas is behaving. It tells me that we need to be a bit careful with the Norwegian kroner. Anyway, I've been playing it, as people in our room know, and I'm watching it for possible re-entries. Anywhere between 10, 12, 14 and this 10, 17 looks attractive just for now. And then Ryan already mentioned it. Dollar China broke up. There's a few levels. So we did retest, as I showed already a couple of times, those low 690s, and then took off again, broken above the prior high. There was this fib around 70070, and now we are like we are in a test mode of 2020 spike lows, and I think we need to respect those a little bit, just being Friday. So I managed my books, and now waiting for what's going to happen next. For me, that's really enough for now. Ryan, you can take it back. Oh, hang on. Euro yen. Yeah, Euro yen is let me quickly take that one. Euro yen is an interesting one as well. I've been showing this line. We've broken a number of times above, but this 144.30 was a bit of a magic level in the end, and we are back below. So I'm looking at this 142, and where are we? This 142.40 is a level in my opinion, and then the 140. Let me see. Let me put this correctly and take the whole move. So right, this is where we are. This zone 142.40, 142.60. We are right. We're on it. So that's going to be relatively important for the rest of the day. Thanks, Gavin, once more. And with that, back over to you, Ryan.
Yeah, thanks, mate. Gavin, we have to get you a slot on the show at this rate, mate. You're putting the levels out the hat. Very good, very good. Right, Austin's asked, what's the risk to holding positions over this weekend? One of the risks would have been dollar yen if we'd have still been, breaking new ground. We're looking pretty steady, as I say, going into the close. We're not jumping around 200-300 pips at a time. So I think that the risk is lower for potential action over Sunday night, Monday morning. But as Kay pointed out earlier this week, there is a market holiday in Japan on Monday, Respect the Aged Day. So markets will be closed, but that doesn't mean there won't be someone keeping their beady eye on things should there be any moves of note over the weekend. It's also a UK holiday, bank holiday on Monday, obviously for the funeral. So that's, UK market shut. Something to watch out for the quid, obviously. Just to let you guys and girls know, there will be no flow show on Monday because of the funeral. It's a bank holiday. So me and the family and some of our extended family all getting together just to have a nice family day and watched the funeral. So there will be no flow show on Monday. We'll return on Tuesday. Back to Japan. There's also a holiday on the 23rd, another market holiday on September the 23rd, which will be obviously after the Bank of Japan. So a short week in Japan next week. So keep that in note as well. But as for this weekend, I don't see any real risk events on the horizon. Kay, you got any anything on your binoculars?
No, not really. Apart those meetings still going on in Uzbekistan, and you never know who can make a comment that drives risk even a bit more mad. So that's likely going to be the main event risk. And yeah, whatever can happen in Ukraine, we heard about those counter offensives, the Russians pulling out, but then now with the meetings done between Putin and Xi, God knows what they have been telling each other behind the scenes that has not been reported. So there's always that risk overhanging. I don't think I will have a lot running over the weekend. We have done pretty decent moves, and next week is another week with more central banks. So I'm going to keep my risk very contained for going into next week.
Yeah, and we could see markets as carry on going a bit sideways with the closer we get to the Fed. Not too much positioning going on, maybe some last minute exiting of positioning for the risk event, as we tend to see. But yeah, keep an eye on that. Just one thing quickly, gold. I want to just give a big thumbs up to Stelios, who yesterday, more instinctively than anything else, went short into just above that 75 level and took the break there. Very well done. We got a fairly big break there.
We are not seeing
I was long on it into the level and flip short, and now we're going to see if we get a move down. But I just wanted to give Stel a bit of a fist pump there for his call on that gold one there.
Ryan, we are not seeing any screen.
Oh, what am I doing? I forgot to share it again. There we go. So yeah, the big break there, 1675, 1680, big level. These are the ones that are technically lovely to see. So as I say, I think we're still getting about 80, was it? 76, 78, 80?
No, at 86.
Maybe even a bit higher, if you remember, Kay.
86.
But, he's got that breakdown. I think he's targeting 1620 for that one there, but we do have a bit of an area around 1640s, and then the 50 fib of that big move from 2019 coming in at 1617. So if you all saw that yesterday from Stel, if you're following that, you've made some good pips. I don't have much else to add for the rest of the day. If you guys and girls, yeah.
He went in at 1686, by the way.
1686, that was it. Yeah. So nice pips there made, and there's a few of us now short. So let's hope it continues lower. And anyone else who got on that, well done to you too. As I say, I've not got an awful much more to add to today's proceedings. So I will let you guys and girls head off into the weekend. Enjoy yourselves. Trade safe. I hope you've made lots of pips this week. I hope we've helped you make lots of pips this week. And if you haven't made any pips this week or are struggling, we are here to give you advice, to help you out. Come into the platform. You can speak to anyone you like about any subject you like, and we're here to help. So until next week, thank you to Kay. I'll say thank you to Stel when I see him later for this week. Have a great weekend, everybody.
Have a nice weekend.